Good evening. Thanks very much for joining us on this special show. I'm Shireen Bhan. The Indian economy is in a difficult situation, but a recovery is not impossible. That's the word coming in from Chief Economic Advisor Raghuram Rajan, who presented his maiden economic survey on the eve of the Union budget. The survey was unveiled today. It expects growth to pick up in FY14, pegging it between 6.1 and 6.7%. The survey also expects the Finance Minister to meet the fiscal deficit target of 5.3% in tomorrow's budget and 4.8% for next year. It projects that there will be cutting of subsidies to prioritize expenditure and increase the tax to GDP ratio as a key to fiscal consolidation. What should we make of the economic survey, and what cues should we pick up for the budget, which will be unveiled in less than 24 hours from now? Joining us now to discuss all of that and more, Soumitra Chaudhary, member of the Prime Minister's Economic Advisory Council, former Chief Economic Advisor Arvind Virmani, Nainalal Kidwai, President of FICCI, economist Indranil Pan, and from Bangalore, Kiran Mazumdar-Shaw. Appreciate you joining us here on this special edition on CNBC TV 18. Soumitra Chaudhary, let me start by asking you about the growth projection that Raghuram Rajan has put out in the economic survey. It's a very wide projection, all the way from 6.1 to 6.7%. What do you make of that growth projection, given the fact that in the previous economic survey, the projection that was held out by Kaushik Basu went horribly wrong, and also the Chief Economic Advisor very clearly saying you cannot anticipate the uncertainties. So what do you make of this 6.1 to 6.7% range? Because the sense on the street is it's too ambitious and too optimistic.
Well, I think it is a fact. It's very difficult to forecast growth for next year, given that this year has been a terrible disappointment. Every quarter has been a disappointment. Every new monthly data release has been a disappointment. So at this point, sitting here, it's easy to be overcome by events and to say next year is going to be just as bad, maybe just as worse. It's the easier way out. I don't think that will be the case. But to be able to actually say with a great degree of clarity that this is how we'll be able to improve, I think would not really be possible. So you can only fix a range. In fact, the only thing I have an armed quarrel with the 6.1 to 6.7 is how they got the number 6.1. I mean, if you really say, look, I don't really know, would it not have been simpler to say somewhere between 6 and 6.7 or 6.8%? But in any case, I think a wide range is a judicious choice. There is going to be a lot of uncertainty, and it could be, but market says it could be wrong. Yes, I think the events the last several years have shown us that, in a sense, extreme tail behavior is quite common. You get very disappointing outcomes. Who would have ever have thought that in 2010-11 we grew by 9.3%? So both sides, you get a lot of extreme volatility, and it's very difficult to get a fix today.
All right, so you're hoping that it doesn't go horribly wrong this time around. But let me get the economists on the panel in Indranil Pan. The view on the street is too optimistic and ambitious on the growth side, and perhaps too conservative on the inflation projection side. What do you have to say?
I think the way we should be looking at the numbers, and this flows across the economic survey, and at every point in time, every chapter, there are certain factors that have been raised in terms of how you need to debottle growth. Now, a lot of these things may not be achieved within the scope of 1 year. But my belief is that the underpinning of the assumptions on this growth is that the global recovery happens. It becomes much better in 2013-2014 than in the previous financial year. It is underpinned on the fact that we should be seeing a lot more sort of monetary easing from the Reserve Bank of India, as it clearly says that there are adequate scope for the Reserve Bank of India now to sort of act. It also underpins on the fact that we are looking at a fiscal consolidation. But I think, unfortunately, what we may be missing out immediately is that there is definitely a challenge in terms of investments picking up, because the visibility of demand globally as well as in India is not too strong enough. And given the fact that we are looking at more in terms of an austerity measure, that itself could be be headwinds for the overall growth projection.
You're absolutely right. Naina Lalkidwai, let me put that point to you, because that is the fear that on one side, while the market is saying that the government needs to get its act together as far as fiscal consolidation is concerned, put together a credible fiscal plan, and the government has been working towards that, now there is a sense and a fear that perhaps in the quest for fiscal consolidation and austerity, we are going down the road of sacrificing growth, and now the onus is on the Reserve Bank to actually jumpstart growth, and fiscal policy is shifting now to fiscal consolidation and austerity.
I think, Shireen, I have absolutely no doubt that embarking on this course of fiscal consolidation is key. We have to be able to contain this because, in fact, if we don't, it's a very big price that we're going to have to pay going forward. Now, if you look at some of the near-term gains we can have, I was just looking at the ICOR numbers, the capital output ratios, which are standing at 5%, where until recently, even last year and year before, they were at 4%. And in fact, the Economic Advisory Council to the Prime Minister has suggested that 3 is the ideal. What this tells us is that there is capital locked up in unproductive assets, and we have to work and probably not have to work too hard to ensure that these projects kick in. So if we can work to ensure that the projects that we started actually kick in, it's going to be very important to bring these investments back to life. The money has been spent. It's a case of making this money now work for us. The other is, and you've heard me say this before, GST. Now, GST may not kick in enough to give us a huge kicker for the whole year next year, but should it come in some stage in the course of next year, it will help, because our estimate is that it kicks in 2% to the GDP after it's in full form. So maybe some part of that benefit could be available to us next year. Monetary easing and lowering of interest rates, yes. Bringing investment back, bringing industrial production back are going to be very important measures. And the world is a better place too going forward this year.
Sure, but that's where the question mark is on how quickly we are actually going to see the investment cycle turn, how quickly we're seeing the capex cycle pick up, and there are no clear answers on that front. Arvind Virmani, as the former chief economic advisor, let me ask you, what to your mind has been the highlight as far as this economic survey was concerned? And if I were to ask you to link what we saw Raghuram Rajan put out today and what we can expect from P. Chidambaram tomorrow, what do you think will be the theme?
Well, I think you asked a lot of interesting questions. As far as the economic survey is concerned, I think that I was quite interested in Chapter 2, because you probably don't recall, but I started the Chapter 2 as a kind of analytical and somewhat forward-looking chapter in the economic survey. The traditional economic survey, the rest of the chapters are backward-looking and more a statement of fact historically than... a lot of people told me that those facts are useful across the country. In Delhi and Bombay, we discuss all these things every day, but people across the country look forward to that as a kind of factual statement. But coming to 2 other interesting questions, certainly there's uncertainty, but I'm reasonably confident about one thing, and that is that growth will pick up over the course of the year. In my mind, the uncertainty is more about the pace, the speed of that recovery, and I feel reasonably confident, and in that sense I disagree with the growth projections. I would be 50% confident of a growth rate of 6%. But of course, that doesn't mean a higher one is not possible, but I would just give it the more than 6%, 30% probability, and perhaps a 20% of less than 6%. So that is the second question. So I do believe that the economic survey is a little optimistic on the growth side. And your third question, I think, was on the fiscal and monetary policy. Yes, I have coined this word. I call it a macro pivot. We need a macro pivot, which is a rebalancing of fiscal and monetary policy. Certainly, if there was only a sharp contraction in fiscal policy and nothing else happened, then even that 6% would be in doubt. But what I expect and what is needed definitely is this pivot, that you need to have a much tighter fiscal policy and a loosening up, equivalent and simultaneous loosening of the monetary policy. And I feel
all right,
that
I'll come back to you on the rest of that in just a bit, Mr. Virmani. But let me get Kiran Mazumdar-Shaw in on the discussion. Kiran, you know, I just finished a conversation with Raghuram Rajan, and I asked him, I said, what are the levers that you're actually betting on to go from 5% to 6.1 to 6.7%? That's the range that you've held out, and a lot is being now being sort of rested on the fact that they hope that public sector companies will actually kickstart the investment cycle and the rest will follow. The finance minister believes that if you don't invest, as far as PSUs are concerned, you know, pay it back to us in the form of dividends. So there is that gentle nudge. But how confident is corporate India feeling? Because my conversations with CEOs, nothing seems to reveal that the level of confidence has come to a point where we are actually seeing a turnaround and a pickup in actual investments.
I personally am very skeptical about the investor confidence coming back to really pursue this 6% growth. Personally, I'm also very concerned with the way the finance minister is going to manage the growing fiscal deficit. In fact, I just hope that we are not looking at deferred spends, because really the kind of subsidies on oil and fertilizer, which almost translates to 100,000 crores, is going to be deferred to the next fiscal. Now, is this a way to really, assure ourselves that we are doing the right thing and containing the fiscal deficit this fiscal, is my worry. Secondly, I'm not seeing any kind of policy measures being announced to kickstart investment in manufacturing. I also believe that, the whole agricultural sector, which really needs urgent attention, which is really the cause of a lot of our subsidies, is not being looked at with any innovative measures. I personally believe that, the kind of subsidies and loan waivers that the agricultural sector is receiving today needs to be converted into credit-based incentives for cooperative farming. Because without economies of scale, you are not going to see technology being leveraged to improve productivity, efficiency, and take jobs from land to industry. So I really am very concerned about all these kind of policy measures, and equally I'm looking at the economic survey, where there is a huge section devoted to job creation. Are we really going to create real jobs? That's my real concern. Where are the key, the enablers for entrepreneurial jobs? Where are the self-employment incentives?
Okay, Indranil Pan, let me come to you, because there is a crisis of credibility here as far as the math is concerned, and let's get down to talking about subsidies. While the government seems firm in its intent to prune the diesel subsidy by 45 paise a litre every month, they've been able to do that for 2 months now. We don't know whether they will be able to carry that forward, but that's clearly not enough, which is what the survey very categorically articulates. But the other issue where the survey actually makes a big pitch for the food subsidy bill, and in my conversation with Raghuram Rajan, he says that food subsidy is something that India needs. We can go the food stamp way if necessary, but that is something that we need. Again, the estimation as far as the bill for food subsidies is concerned, perhaps a tad too conservative. The question mark remains on how we're going to fund this. Indranil Pan, your view and your worry there.
Definitely, the worry continues on the subsidy side, but I think more than the food subsidy, also we need to look at the oil subsidy, because in his attempt to balance the budget, I am sure that like in most of the other previous years, the finance minister is not going to very transparently put down what he expects the subsidy that is needed for the oil bill. In terms of an X assumption for the overall average for the oil prices for the year and the type of currency momentum that we are looking at. So I think that would be one big difference that has always happened between the budget estimate and the final estimate, which keeps concerning. Yes, food subsidy is an essential element, and which in a socialist economy like ours, it is very difficult to do away with. But gradually I am starting to once again focus on the interest payments, which is actually sort of increasing in a very significant way. And just to bring the whole picture in perspective, before the Lehman crisis, we were borrowing at around, the central government was borrowing about 1 to 2 trillion rupees. Immediately post-Lehman, it went up to 3.5 to 4 trillion rupees. And now it is nothing less than 5.5 trillion rupees. And going forward in 2015 financial and 2016 financial, the redemption pressure of the government is upwards of 1.7 trillion rupees. So if the gross borrowing of the government is averaging about 7 trillion, even if I give the benefit of doubt in terms of interest rates, say at an average of 7.5% for the government, it easily adds about 50,000 crores to the fiscal. So that is, I think, the next focus, because the assumption was that the capital flows would be strong. The assumption was, therefore, the RBI would pump in liquidity in the system, and that would be used to buy back debt, which is not likely to happen in the near future.
Okay, Nana Al-Kidwai, it is very clear if you read the economic survey and from conversations that we've been having that the current account deficit, which is at a record number, is the #1 concern as far as the government is concerned, because it doesn't have too much control on how it can be able to tackle it. It's spoken about gold imports, the need to contain and curb that. We've already seen some measures being announced on that front. A specific mention also being made on external commercial borrowings. The document notes that ECBs need to be monitored very carefully so that entities without access to foreign exchange revenues do not leave significant exposure unhedged. You know, the CAD seems to be the #1 enemy at this point.
And it is a cause of worry. And Shireen, of course, the big one there is the oil import bill. And that is something which, in some sense, is a tragedy, because India could have done so much more, and it is going to take us time to do that, to develop our own gas reserves and renewable energy and whatever it takes to get our own generation in the country up to a level which begins to bring the oil bill down. And, you know, look at the success the U.S. has had through its shale oil embarkation. But the fact is that that problem is not going to go away in a hurry, so we're stuck with it. You're right that gold is the next big element, and there is clearly now concern being raised on that, and the desire at any rate to contain that. ECBs, you know, as long as we don't have a debt market in the country, and we have been really arguing that this is something that needs addressing, we export our debt markets. And what we have got as a result is companies being able to borrow offshore, whereas we do not have a robust enough debt market to enable them to borrow as effectively here. And that is something that we could correct in the near term and make it much easier for, and also the funding available.
Well, that's been the hope for many, many budgets, Nana. That's been the hope for many, many budgets. But I'm afraid we're going to have to take a quick break. Quick break on that front. We'll continue with that conversation. Raghuram Rajan also saying we need to do a little bit of everything on expenditure and taxes. We'll discuss that when we return on this special show. We're discussing the economic survey, the first one presented by Raghuram Rajan. Welcome back. You're watching the special show. We're discussing the economic survey, the first presented by Raghuram Rajan. Arvind Virmani, let me come to you and let me ask you, as a former CA, when you hear a chief economic advisor actually saying we need to do a little bit of everything on expenditure and taxes, would you read that as a hint or a signal that we are going to see taxes being moved up tomorrow?
See, the macro analysis tells you very clearly that the fiscal and revenue deficits have to be controlled. And given political constraints, even though the economics, as far as my economics tells me that the reason why the fiscal deficit has risen so much on a trend basis is because of expenditure, and on a cyclical basis because of taxes, the analysis is pretty clear. And so in that sense, this is one hint you can probably take for the budget, because it's not specific. As you know, in recent times, the Parliament has been fairly sensitive. So the economic survey will not give you a specific indication of anything that might happen tomorrow, because parliamentarians will be offended by that. But this general statement is probably correct,
your reading
because
and
we
your
can
sense?
anticipate
Do you expect?
that.
Sure. But do you anticipate a hike tomorrow on things like excise, service tax, etc., and perhaps some bold moves on the direct taxes front as well?
Well, that's an interesting question, because according to my analysis, we should have actually reversed the decline in service taxes and excise duties which we put in place in 2008-9, starting 2009 and making it much stronger in 2010-11. So to the extent that's not happened, and to the extent it fits into the expected rates for GST, yes, that would be a good bet.
That would be a good bet. Soumitra Chaudhary, the perception in the market seems to be one that you cannot achieve fiscal consolidation only by squeezing expenditure. You have to rely on revenue mobilization as well. Just squeezing expenditure is not desirable or tenable.
It depends on what expenditure gets squeezed. I mean, let's put it like this. This is fiscal consolidation is always about two hands clapping. You cannot fix the fisc only from the expenditure side. You cannot fix the fisc only from the revenue side. You need to do it from both sides. That's given. But within expenditure, clearly, what is the category of expenditures that you seek to squeeze? If you squeeze productive expenditures that create assets in the longer term, both human assets and capital assets, then that's going to affect your medium-term growth. If you, however, squeeze that kind of expenditure which does not have a direct link to growth, then you have some amount of flexibility. On the other side, on the revenue side, you need to be able to see where your revenues are running short. Can you expand your revenue base without creating disincentives for growth and investment? And you have to find imaginative ways of doing both. And there are imaginative ways, but there are also limits to the imaginative ways, which is why I think nobody is looking at fixing the fiscal problem in rapid start. I mean, go from, say, 5.3% this year to 3%. You can't do it. You have to do it in phases. But the phases have to be a combination of at least relative reduction of unproductive expenditure and also looking at those ways of increasing tax revenue. The best way, of course, increasing tax revenue is growth, because you get growth, you get tax revenues from increased output. But if there are any other methods, or let's say any other ways or any other potential for raising revenue without creating disincentives for growth, so that I think is something that you always need to bear in mind, that if you increase revenues in a way that actually makes people not interested in investment or growth, then of course you have defeated your own purposes.
Indranil Pan, what could those imaginative ways really be for revenue mobilization? And let's look at the picture. Manufacturing down to 1.9% from 2.7%, already coming off a very low base. Growth in services from 8.2% down to 6.6%. Do you believe he is actually going to move on revenue mobilization in terms of higher taxes this time around, given where growth stands?
I personally am not expecting any increase in the excise rates and the services rates. I would agree with Dr. Virmani that they should have been adjusted back to the pre-Lehman days. But my opinion is that they should have been done in the previous years when growth was much, much stronger than what it is today. And therefore today is not possibly the right time to do that. In terms of revenues, I think the challenge is that we continue to have a much bigger reliance on the manufacturing sector from the corporate taxes, from the excise duties for the revenues, and given the fact that manufacturing sector is slowing down, that's the bigger problem. So I would expect the best thing that the finance minister could actually do at this point in time is to try and widen the net as much as possible, make compliance an issue in terms of providing that upward momentum in terms of the revenue mobilization. And there could be, in my opinion, whether there could be a chance in terms of bringing back a little bit in terms of the customs duty on the crude oil, which was brought down from 5% to 0%. So that could be one area where we can be sort of looking at revenues. Plus a bit of revenues could be coming from the gold, where I expect an increase in the customs duty, because on the CAD side, the gold also is a problem area.
That's what we're picking up as well, that there could perhaps be some change as far as customs duties are concerned. Kiran Mazumdar-Shaw, the survey says this is a wake-up call for increasing the pace of actions and reforms. We're 24 hours away from the budget. What do you expect him to say? Because, you know, things like GST, while everyone has talked about it, there still doesn't seem to be an enough breakthrough with negotiations with state governments for him to actually set out any kind of a rollout timeline or plan of action in the budget.
Well, I think, you know, GST is something that has to be forced through. I think, you know, as Naina said, I think this is going to make a difference. At least it will add on to GDP. And apart from that, I think you do need to, you know, look at how are you going to improve your business competitiveness in the global market. I mean, you need FDI. There is lack of investor confidence. I don't think you can tinker much with taxes and service tax and even MAT for that matter, because we are seeing decline in manufacturing, decline in services, which is very alarming. So I think
are you expecting a surcharge though, Kiran? Are you expecting a surcharge perhaps on the super rich, a higher rate of dividend tax on dividend income for the super rich? Because that seems to be the sense we're getting.
Well, you know, I wouldn't be surprised if they would make a small start there, but I don't think that's going to really answer the huge, you know, fiscal deficit and other challenges that we are facing. I think we need to see good reforms and enablers. I really think that we need to see, you know, investor confidence back, because otherwise you're not seeing cost of capital is becoming very expensive. When you look at kickstarting the manufacturing sector, how are you going to do it? There is, you know, these are urgent issues. Infrastructure is woefully inadequate. There is no investment going on into the investor sector. And as Naina also earlier said, we've got a lot of unlocked investments that we need to look at and see how do we translate that into revenues and into growth.
Sure. Unfortunately, I'm running out of time. Naina Lal Kidwai, last words to you. Do you go into the budget feeling hopeful that we are likely to see a big bang budget or at least a bold budget, or you go in feeling cautiously optimistic that it's going to try and right the wrongs from the previous budget and, you know, not throw up any negative surprises?
Well, I wish I could say big bang, but it's a tough corner, and cautiously optimistic is probably more the mood. I take heart from the fact that the economic survey does talk of growth and wanting to see growth return, and therefore the measures that we will see come back in, I'm sure, are going to kickstart growth, which is really an imperative we've got to bring back for the next year.
Well, as Raghuram Rajan said, high growth trajectory may look improbable, but as Mandela said, it always looks improbable till it's done. Let's hope that actually translates into reality as far as the Indian growth story is concerned. Arvind Virmani, Naina Lal Kidwai, Kiran Mazumdar-Shaw, Indranil Pan, Soumitra Chaudhary, appreciate you joining us here on this special CNBC TV 18 discussion. We'll be back with the budget tomorrow. Till then, from all of us here, goodbye and thanks for watching.